Good day, everybody. Thanks for being with us. We're very happy to be back here with you for another session, this time talking about the strategies for cost optimization. 2020, our industry has gone through a very, very challenging time, a time that nobody had experienced in the recent history. As a matter of fact, any playbook that was available was essentially thrown out the door. A lot of the companies put very aggressive cost containment strategies with staff furloughs, with operating standards changes, and also working with their lenders to make sure that the debt workout is being done. Today, I'm here again with my co-host, Sam-Erik, to deliver some of these strategies, talking with our panelists with you. Sam, over to you.
Yes, thank you, Abid, and good morning, good evening, everyone, and thank you for joining the Hospitality Talks show for this one. Of course, this topic is one side we are looking at the history of the annus horribilis, but we also like to look at the future because I think we all live for today and for the future. So I'll be very interested to hear what our panelists have to, in their view, have to say and where we are heading. Hopefully 2021 or maybe a couple of years after that. So Abid, with your permission, let me bring everybody to the screen and let's get started.
Yes, please. Let's do that. So, Sam, today, as you know, we have a wonderful panel put together. Rob Mandelbaum, who is Director of Research Services with the CBRE Hotel Research. He's in charge of research information services and produces annual trends report for the hotel industry. We also have with us Rob Hayes, who is the president and CEO of Ashford Hospitality Trust. It is a real estate investment trust focused on investing predominantly in upper upscale and full service hotels. And last but certainly not least, Daniel del Olmo, who is the president and chief operating officer for Sage Hospitality Management, a group that has a portfolio of more than 50 hotels around the country that operate some branded, soft branded, and independent hotels. So, gentlemen, welcome to Hospitality Talks.
Thank you.
Thank you.
Thank you.
So, in the interest of time, we've got quite a few people that have joined us live today, and I'm sure there will be lots of questions. So, Robert, I'm going to start with you. I'll have to make sure that I say Robert and Rob so that you know who the question is addressed to. But Robert, I'm going to start with you. If you don't mind telling us a bit of brief overview of 2020. What was it like? What is the data that you have collected? What is it telling us?
Well, first of all, thank you very much, Abid and Sam-Erik, for the opportunity to participate in today's presentation. Well, if you were depressed looking at the top line numbers when reviewing your performance in 2020, unfortunately, it gets a little more depressing when you look further on down the income statement and look at the bottom line. For the sample of properties that we tracked P&L performance for during 2020, we saw total revenues decline approximately 57%. At the GOP level, we saw the profits decline approximately 78%. What that implies is the fact that operators were able to, operators were able to generate sufficient enough revenue to cover their direct operating expenses and the undistributed expenses. However, unfortunately, when you get down to that bottom line or EBITDA, we did see declines greater than 100%, which does imply that, again, most properties, unfortunately, were unable to generate sufficient cash from operations to contribute towards debt service. Of course, performance varied depending upon what type of hotel you were and what chain scale you operated in.
Robert, you have just completed your analysis for 2020 with a precipitous drop in revenues, as you talked about. Were there hotels by chain scale or by hotel tract that performed better than the others? Were there markets that performed better than the others? Can you help us understand that a little bit?
Certainly. Well, yeah, again, using the new definition of better in 2020, which is less of a decline. Um, in general, if you look at chain scales, sort of a reverse linear relationship, the higher price chain scales unfortunately did suffer the greatest declines in profits. Understandably, the upper upscale segment, which is mostly the big box convention oriented hotels, they suffered pretty significant declines at both the GOP level and the EBITDA level. Um, in general, the lower priced, economy, mid-scale properties, um, they too suffered declines, but not in excess of 100%. They did achieve some degree of a EBITDA margin, 10, 15%. But if you look at those margins, they're still 3,000, 4,000 basis points less than what they would historically achieve. Property types, again, convention-oriented hotels, the lack of group demand, they suffered both in terms of revenue and profits. But what has been, discussed a lot, the relative success of extended stay properties. Even their relative stability during this market. We saw their profits decline 50% at the GOP level, 70% at the EBITDA level. So not a good year. Very, very few exceptions.
So, Robert, in a year like we have just had, what statistics are really indicative of the performance? Because quite candidly, whether you look at the revenue per available room or cost per available room versus occupied room, those stats at the end of the day are really become somewhat meaningless because there has not been a year like this, and hopefully there will not be another one like this for a very long time. We'll keep preparing for that. But what stats really are meaningful when you're reviewing the performance for a year like the one that we just had?
Well, yeah, again, as always, when you look at statistics, you really need to have a full breadth and understanding and make sure you're analyzing them properly. I'll actually say that, looking at some departments per available room, per occupied, you do see a different story. So let's look at the undistributed departments and the expenses there, rooms, F&B, other operated. Of course, because of the drop in business volume, we saw tremendous declines in expenses because of the cost controls put in place. Business volumes down. Historically, hotel managers have reacted. They put their cost control measures in, and we see declines in terms of total value dollars or dollars per available room. But what's most revealing is when you look at those operated departments, the declines in per occupied room. So that means for every room that was serviced, the amount spent by the hotel was less than what they spent in 2019, and I think that's indicative of those strong cost controls and dipping into the fixed expenses. One of the jokes we've been making is, a COVID casualty was the notion of a fixed expense. And I know, we wanted to talk about break even and such. We all learned break even expense. You look at your fixed, you look at your variable expenses. I think in 2020, what we learned is that maybe fixed expenses aren't so fixed. So per occupied room, seeing the declines in there, really indicative of management's response, stepping up to the plate, looking at all expenses, and making those cuts.
So you bring up a great point that what was typically labeled as fixed expenses, maybe they are not fixed expenses because of the decline that we have seen this year. Again, an unprecedented year where virtually there was no business, there was no revenue, or it completely fell apart. are there other comparable years that we can look at? The last down cycle, global financial crisis, 2007, 2008 time period, at least there was some revenue coming through. Are there any comparables that we can point to where we might have done better or worse relative to cost issues?
Okay. Well, don't let my gray hair take you in one direction, but I do have the pleasure of having the old PKF database that goes back to the 1930s. So, we've been looking a lot at the historical recessions. There have been 11 since 1930 up to this point in time. And, far and away, the, 80% decline in GOP during 2020 was just significantly greater than what we saw 2001, 2008. 2008, to put it in perspective, the decline in GOP was approximately 29%. Back in the 2001 recession, 18%. Going back to the 1930s, it was 15, 10%. So, comparing 80% to 30% in 2009 just shows, how significant a fall off it is. We even looked at the occupancy level from what we tracked, 41% roughly for the year end. It was like 39%, 1932, 1933. So, we're down at, all-time lows. The GOP margin, 19.7% in 2020. Previous lows, early 30s, early 80s. I'm sorry, early 70s, early 80s. Maybe around the 28, 29%. So it definitely an all-timer in terms of struggles on the profit statement.
So, Robert, you obviously have a much wider view of the industry nationwide. You collect data, you analyze data. Last time I saw you, you did have black hair, but now it's turned gray. I don't know if it was 2020 that caused it, and that's a casualty of COVID. But were there any learnings from when you were analyzing the data? Anything that particularly stuck out that you would have said, geez, I haven't seen that before? Of course, the drop we've talked about, but were there other things that stuck out?
Well, I think the cost controls, last March and April, as COVID was first coming and we were struggling to make projections, not only at the forecast of market RevPARs, but how's it going to impact the operating statement? We look back at the historical recessions, and there weren't many times when you saw 30, 40% occupancy levels. When you did, quite frankly, for those hotels, the fall off and then the margins were even greater than we saw in 2020. So again, if there's any solace, we're doing better at 30, 40% occupancy levels than we have in the past. Again, all credit to operators and the cost controls put in place. But that's still, not to deceive anyone, that's still an 80% decline in GOP, even though it might have been expected to be 90% if you look at historical precedents.
I'll turn it over to Sam in a bit, Robert, but talk a little bit about the notion of break even. What types of hotels do you think will have gotten to the break even point at what occupancy levels? Because obviously the way the hotel's chart of account has worked, we put a lot of the miscellaneous costs all under undistributed. But talk a little bit about the break-even level as to what is the absolute minimum occupancy that we are not having to dip in our pockets to fund it.
Mm-hmm. Yeah, so that's a great question because typically when you look about break-even, there's different levels. The operating level, GOP, measuring the effectiveness of management. But this year we saw a big study about what's the occupancy level I need to break even at the EBITDA line, because that's what everyone was worried about. Will I have cash pay my debt service. And, lenders were worried, owners were worried. Um, in the past, for the GOP level, maybe you wanted to be at, 40% at least, 50% to, again, draw an absolute zero break even at the bottom line. What we saw this year, though, again, um, all property types except for convention hotels did achieve some level of a GOP margin. And that, again, it's those expenses that are under control by management. However, when you go further down and you look at things like property taxes, insurance, any rent that you have to pay, generating enough cash to cover those, that's where we saw the struggle in 2020. So, were hotels breaking even at the GOP level? Yeah, most of them were covering revenue to earn a profit at that level. But at the bottom line, again, extended stay hotels, interestingly enough, some resort hotels achieved a bit of an EBITDA cash flow, but it was a real struggle for all classifications of hotels to earn something at that bottom line.
Thanks, Robert. I'll be back with you in a second. Over to you, Sam.
Thank you. Looking at the US from Helsinki, Finland, where I'm sitting now, I simply have some ideas of what the US is going through, and particularly looking at the statistics that you have excellently put together. My question is, are there any particular areas in the States that may have performed a little bit better than the others, or would that be perhaps in the leisure section or segment, or what areas? If you can just share your views on that.
Yeah, and I think that's more of a top line influence. It's been well documented, the drive to leisure destination, and we saw that in our statistics in terms of looking at hotels. Like I mentioned before, surprisingly enough, the resort properties in our sample that we've been tracking fared fairly well, at least on the top line, albeit there was a bias in that sample towards higher priced resort hotels. Interestingly enough, resort properties at the high end actually started to see some year-over-year increase in ADR during some of the summer months and during the latter part of the year. However, at like a 25 or 30% occupancy, indicating that the people that were staying there were the high-end leisure travelers that could afford that. Unfortunately, to service those high-end guests, you also have to provide a continuation of a high level of service. So even with the ADR, relatively strong ADR performance, it didn't really flow through to the bottom line. The rural markets, and again, I think that's just more of a people wanting less density, greater opportunity to have social distancing. So that I'd say would have more of an impact on the top line than the bottom line. Then you get cases in terms of expenses. It's again been well documented. The urban core, the New Yorks, union-oriented properties, less flexibility with labor costs. So those properties hurt, and then probably why we saw the greatest degree of temporary closures in the New Yorks and San Franciscos and Chicagos of the world.
Thank you. For further questions, maybe Abid, you could continue on this. So thank you very much.
Thanks,
Robert.
Thank you, Sam. Robert, any prognosis on 2021? Because there were lots of one-offs for 2020 that hotels were able to book, whether it was standards deferrals that brands had put in and the operating entities put together. There might have been cancellation and attrition charges that were recorded on the income statements, but those were one-off. What do you think 2021 is going to be like?
Yeah, thank you. That's a great question, and a question that I know we've been contemplating, and a lot of our clients and have been asking us. Look forward to hear what Rob and Daniel have to say. How much of these cost controls will stick going forward? Again, when we started COVID and we look back at past recessions, one of the things we did notice is that coming out of the 2001 and 2009 industry recessions, the industry learned lessons, and some of those cost control measures did seem to stick. And we saw those margin improvements better. Yeah, pre 2001, if you look back at the original 9 industry recessions, profit recovery would occur 2 to 3 years after revenue recovery. But it was fairly close. Coming out of 2001, 2009 recessions, profit recovery was pretty much concurrent with revenue recovery, i.e. returning back to the levels seen the year prior to the recession. So we think that's going to continue. We think that owners have certainly enjoyed some of the cost cuts that the management has implemented, and what will want those to continue. But I think it's going to be a struggle. You mentioned brand standards. It's all up to the franchise companies to see how strict they're going to be. I think at the luxury level, it's going to be tough not to restore some of the services and amenities cut at those hotels. And again, we saw some of the deepest declines in profits at the luxury level because of the need to retain a relatively high level of service and amenities. So that's the big question. I haven't quite fully answered it myself. Again, I look forward to hearing the thoughts of the other panelists.
I think that's a great segue, Robert. Thank you for giving us an overview. Please stay with us. We'll have you back in a moment. At this point, I'm going to bring Rob Hayes, who's again President and CEO of Ashford. Rob, thanks for being with us.
Absolutely. Morning, guys.
You have obviously gone through a lot over the last year, and as one of the articles, I think you had even posted it, you have saved the company from the brink of insolvency with your most recent capitalization effort, and the article read, "Die Another Day." Talk a little bit about that. Tell us, what was that like? Because obviously that is a very, very tough situation to have gone through. By the way, congratulations for working through that, but help our viewers understand what that has been like.
Sure, absolutely. And like I said, thanks for having me. 2020 was undoubtedly the most difficult year of my professional career. And I was in the industry during the financial crisis, and we went through that. But this was unlike anything we've ever experienced. And it all started in February and March when we saw what was happening overseas. And we have a phrase that we use here internally amongst the management team, which is, if you're going to panic early. And so we made some pretty dramatic decisions on cost cutting early on in 2020. In early March, we made significant cuts to our employee count, which was just brutal because there were so many people that worked for our companies that were great employees, were employees that we had to let go. It got to the point where we actually furloughed or laid off nearly 90% or over 90% of the employees in the field. And across our portfolio here at Ashford Trust, we had, going into the crisis, 117 properties. We also then cut our operating costs here at corporate by over 25%, and that was almost overnight. And so we had to react to it very quickly. And then starting in April, we stopped making our debt payments because obviously our revenues dropped off the table and we're down over 90%. And so we had all in at one time almost 30 loan pools of over $4 billion of debt, all in default. And I took over the role as CEO in the beginning of May, during the midst of all that. So that was quite a moment for me to try to step into. It wasn't exactly what I imagined or expected as the opportunity to step into a CEO role, but sometimes you take the advantage of the opportunities that are laid out in front of you, and you choose to either take it or run like hell. And so I made the choice.
Baptism by fire.
It was baptism by fire. And so it was a very difficult year, and it was difficult because there was so much we didn't control. You don't control your lenders, you don't control the decisions that they make, and you don't control the decisions that your brand partners and others make. And that was the hardest part, was trying to manage those relationships, try to be a good partner, but try to do what's best for your employees, for your shareholders. And it was frankly a whirlwind, but we as a team here worked together and did develop good relationships with our lenders, and slowly but surely dug our way out of it, to the point where actually even this morning we put out a filing that as a public company that we signed up what's just about our last forbearance arrangement. It's taken that long in order to get all of our forbearance arrangements done across all of the portfolio. But it was a great team effort amongst us, and working with a really good group of lenders and brand partners to make our way through it.
So, Rob, how have the servicers and lenders and all these stakeholders that are involved in managing that side of the business, how has that relationship been? How have you been able to work it through? And I also understand that through 2020, you did lose a couple of hotels through, obviously mutual understanding with the lenders, servicers. You ended up handing the keys over. So help us understand what those decisions were like, and what it's been like to work through some of these challenges.
Sure. It was interesting. I was talking yesterday with some of my colleagues here internally, because we were reminiscing a little bit, now that our forbearances are by and large complete, what it was like over the last 9 months dealing with them. And it really was almost a bell curve like distribution, where you had some lenders and servicers that were extraordinarily aggressive, and I'd say arguably unpleasant to deal with in some situations, and others that were very, very flexible and very willing to work with you in a lot of different ways. And you saw everything in between. And by and large, those who were more balance sheet lenders were undoubtedly easiest and best to work with. None of the assets that we had on any balance sheet loan or lenders we ended up handing back. We had great agreements with them. It really was with the CMBS servicers. And again, we had some that were, I think, very fair and very reasonable to work with, and we managed to sign up forbearance arrangements. And we had some that were much more difficult. But it was interesting to see where they were difficult. For example, we had a certain servicer that we signed up forbearance arrangements on all of the loans, by and large, that had no mezzanine debt as part of it. But the ones that did have mezzanine debt, several of those were ones that ended up going back because they chose to be a servicer that, I guess, enforced the intercreditor agreement to the letter of the law, and wasn't really willing to waive or work with other lenders in the capital stack. And so they forced the hands of some of the mezzanine lenders. And we had conversations with some of the mezz lenders that we ended up giving the properties to. We gave away, I guess we had 13 properties that went back to lenders thus far through this process, out of 117 that we started with. And several of those mezz guys did not want the properties. They would have much rather worked out a deal with us, but that their hands were forced by the servicers. And so it really depended upon I would say, the spirit of the servicer, and did they have more of a collaborative mentality, or were there certain maybe internal incentives to behave in a more difficult way?
So in 2020, look at the transaction side of your organization. You talked about some of the hotels that were lost because of what the servicers did or did not want to do. But did you acquire any hotels? Did you sell any hotels? Can you talk a little bit about that, please?
Sure. So at the end of the day, like I said, we handed back 13 assets. There were 2 full service assets that we gave back. One was in the W in Minneapolis, and another was the Embassy Suites in Manhattan. And those were our 2 full service hotels, and the rest were all limited service hotels around the country. And so we actually put on the market several assets throughout the year to potentially sell. One was the Renaissance in Nashville. There was a Westin in Princeton, and then the Marriott Crystal Gateway that's in Washington, D.C., or I guess in Arlington, Virginia, right there by the new Amazon headquarters. And those are assets that we put on the market, not because we wanted to sell them because we think they have substantive equity value today and are going to be key assets in our portfolio long term. But we had to keep all options open because we did have this capital raise that we were doing that at that point in time we weren't 100% certain that it was going to be successful, and we needed to have as many different, frankly, lifelines, lines in the water to survive. And whether we were looking at asset sales or bankruptcy structures or another sorts of restructuring or capital raising, we had all of those going down the same path at the same time in order to make sure that we survived and we made it through this crisis. Though at the end of the day, here recently, we did sell a Le Méridien Minneapolis asset that we had operated, Marriott had operated the W and the Le Méridien together. And once we lost the W there in Minneapolis, it made much less sense for us to own that single small asset. And so we did pull the trigger on that asset here several weeks ago and closed on it.
So a couple of questions, and I'll turn it over to Sam. First, talk a little bit about hold values versus disposition conversations. What was that like? Because obviously, as I understand, the bid-ask spread is pretty huge even today. So help us understand what that was like in the assets that you were willing to potentially sell. Did you get any decent bids?
Right. That's a good question. So we definitely saw a material difference between when we put some of these assets on the market in the March-April timeframe and then when we did here in the last few months. I would think that if you look back to what we did in April with those assets tended to be down, let's call it 35 to 40% from pre-COVID values, from maybe 2019 values. And so it was a substantive amount of price reduction. I think as we've seen here more recently, I think the discount to 2019 values is probably maybe closer to 15%, maybe 20%. Seen a few assets that maybe it was as little as 10%, but that's probably the range. Let's call it 15 to 20% down from 2019 values. And I think it's pretty consistent across the chain scales, because while select service assets have they've dropped less obviously in NOI, and I think people see them as more stable, and rightfully so. And so I think the discounts there have been a little bit less. But at the higher end, where operations have been hit much more significantly, people are believing in a long-term recovery, which again they should. And so you actually see them being priced fairly similarly from a discount to 2019. But one thing I'll say, and it was a very interesting part of going through the process we did over the last 9 months, is we spent a lot of time with a lot of household name private equity funds and private equity shops that have a tremendous amount of capital that they've raised over the past year, and even some over the past few months, where they've raised $5 billion or $7 billion or $10 billion funds in the last 3 or 4 months in order to take advantage of the opportunities. And speaking with them, I think they see a lot of opportunity in hotels, because if you look at a ratio of industries or real estate industries that are impacted by COVID, but then also have a high certainty of recovery, I think according to a lot of these private equity funds, they see that ratio as, for hospitality, as maybe the most favorable, because there are real concerns about the long-term viability of things like retail, of office space. And there's been very little drop-off in multifamily and industrial in this recovery. And so when these big private equity funds are looking across the real estate sector, they see real opportunity and EBITDA growth coming over the next several years in hotels. I think as a result, you're going to see values in the industry come back much quicker than people are anticipating, because once these funds start making the determination that they're not going to get the distressed pricing that they all dream of, where they're buying assets at 30 or 40% discounts, and they come to grips with that, and they realize that prices may just need to be a 5% or 10% discount to 2019 values, you're going to see this unleashing of capital. And I think it's going to be a great thing for industry and values over the next couple of years.
So, Rob, one other question. I know that the market has not been very kind to Ashford. Your stock valuation dropped somewhere between, from $44 to $3. The market cap came down from 100 million to 150 million to maybe 24, 25 million. And part of that was the highly levered portfolio that you have in your balance sheet. Do you think moving forward, would that be looked at differently? Do you think that the lenders are looking at capital stack any differently? Your own particular thought process moving forward as to how you would manage your portfolio?
Sure, that's a good question. And I think going into this crisis, we typically had positioned our portfolio to be plus or minus about 60% debt to cost, which as a private company and private funds, I think you're extremely comfortable with it. And I think many people even run at lower level leverage levels than that. And our thesis had always been that we would tend to have a little bit higher levered than some of our peers, but we would keep higher cash balances. And so we had several $100 million of cash that we would keep on our balance sheet, which we felt the combination of that plus only having non-recourse debt gave us the flexibility to manage any semblance of a recession. That's what we did during the financial crisis, and we came out of that crisis with flying colors. This was a whole other level, though. There's no level of debt that could have helped us withstand the entire onslaught of all this. And so it does make you think about what is the right way to approach leverage over the long term. And I think for us, it'll undoubtedly be a lower level. I don't think it'll be running to zero. We do have several of our peers in the industry that are moving almost towards a very, very low, 20% or 10% or less leverage level. I don't think that's something that makes sense, but I think something closer to 40 to 50% is probably makes sense over the long term. But it's going to take some time for us to get there, and that's not something that I can just wave a magic wand and make that happen overnight. It's going to be a process of probably selling some assets, buying assets opportunistically with lower leverage. We've got a few other things going on in our capital stack in terms of we have preferred equity that we're trying to convert into common at times. So it's going to be a longer term journey to get there. But I do think you'll see, as we do have a few assets in the market that we've looked at refinancing, you are starting to see the financing markets start to come back. And you can get leverage today, call it 60% of current values. And almost every day that goes by, those terms get a little bit better. Rates are coming down. They're starting to loosen up on their desires for interest reserves and other sorts of reserves. So I think here in the next 12 months, you'll see the lending markets come back pretty quickly. I think particularly because in this world of looking for yield, hotel assets are obviously ones that are great producers of yield, and you typically are buying them at higher cap rates than other asset types. And so there will be I think a very strong market for hotel loans once the lenders see that a recovery is really underway. And I think that's really the inflection point that everyone is looking for over the next several months.
Well, thank you for that, Rob. And I'll keep asking you questions because I've got a million, but let me turn it over to Sam-Erik, and I'll be back with you in a moment.
Well, I have only one question, and I want to share asking about with the lessons learned now from 2020. And first of all, congratulations of the great performance that you have done during the extremely difficult times. What are sort of the strategic initiatives that you have for 2021 and perhaps looking into 2022?
No, it's a good question. So I think we still need to be firstly laser focused on these cost controls, because while I think we've touched the bottom and the recovery is slowly beginning, we're still down. I mean, look at the upper upscale industry, some of the numbers that Robert was talking about earlier. If you look at Smith Travel numbers here recently, upper upscale where we play is still down 70% year over year on a revenue standpoint. It's just brutal out there. And as you guys know, that's several times worse than the worst moments of the financial crisis. And so I think we still as an industry have to be, and as an operator, we have to be laser focused on cost controls, that as these revenues do layer on, that we're holding on to those cost savings as long as we possibly can. So I think that's opportunity. That's focus number one. I think focus two for us is similar to the previous question, is we have to be focused on getting and making steps towards getting our capital structure where it needs to be. And I think that's something that all hotel lenders should be doing, is looking to see, are there opportunities to either restructure some of the debt that you have, look at your overall capital structure again for where we have a lot of preferred equity in our corporate structure. And that's something that over the long run, I'd like to find a way to reduce a lot of that, something that we did here in 2020. I'd like to keep that ongoing. And then I think once you have those sorts of items, then you start turning your focus to the offense. And I think there are going to be a lot of opportunities in the next several years. I think if you look back historically, usually the best predictor of hotel returns on whether or not you hit your IRRs and your underwriting is typically when you bought. And so historically, if you had bought anything in 2009 or 2010 or even 2011, and you held it for 3 or 4 years, you did great. It probably didn't matter if you paid a quarter turn higher in your yield. You did great. And I think that's something that everyone needs to be focused on, is that I think almost any asset that you buy here in 2021 or 2022 or 2023, you probably are going to have a great return on. And so the question will be, where are those opportunities? And there will be a lot of capital chasing it. And so I think we all just have to be smart about what are those opportunities and really stick to what we all individually do well.
Thank you. We have one viewer, Alex Polling, who asks, and maybe you already have partly answered this, will 2020 affect the amount of leverage debt hospitality companies take on moving forward, and particularly in your case? So he's basically asking, will this affect the amount of leverage you plan on taking?
Yeah, I mean, it does. It definitely does. But there's a balance to it, because you can't operate a business for a pandemic, right? You can't take risk with if you think that you're going to zero, because you've never taken any risk. And so I think there's a real balance to it. So to answer the question more directly is, yes, I do think that we as a company will be migrating to, I'd say, modestly lower leverage levels, something that's more consistent with some of the leverage levels because of our peers. But I don't think we're going to be going to zero. It's an asset-heavy business as an owner, and you have the ability to finance it with materially cheaper capital. And I think as long as you're managing that well and managing the maturity of your ladder of maturities, that it's a much more efficient way to invest and produces better returns to the investors, your shareholders, over time. So it definitely, though, and that's one of the great silver linings to this crisis, is that it makes you, as an executive and as a member of the industry, do some soul searching and really think about who we are, what do we do, what do we fundamentally believe, and do we take the lessons from this and improve. And I do think a lot of us, both in our company and people like yourselves and others, are going to be better hoteliers, better owners, better operators because of this. And we may look back 3 years from now and 5 years from now, and in some ways say, thank God for that crisis, because we are who we are today because of the lessons we learned in 2020 and 2021.
Thank you. It was a great answer. So, Abid, you had a basket full of questions, so let me give them over to you.
Rob, I hope that we will look back and say that, yes, there were lots of lessons learned. But also at the same time, I'm very confident in saying that nobody ever wants to go through this ever again. It's once in 100 years.
I don't want to do this. I don't want to do 2020 again.
Yeah. It's gone. We turn the page and off we go. One question, and we'll bring on our next guest, but talk a little bit about the capital stack as you're looking at debt. The availability of debt, as somebody had more recently told me, that debt relative to hotels have become a 4-letter word, and people are scared. So talk about the availability. What are the spreads like as you're looking at the debt? Is it LIBOR plus, or what sorts of deals are available to restructure some of the debt that is there?
Yeah, good. It's a good question. So I think you still aren't seeing much on the CMBS side. And I think that's going to be the probably the last piece to recover. There've been a few little inklings on the CMBS side, on the floating rate side, but I think that's still a little bit ways off. Again, I think what the CMBS world wants to see first is the shape and trajectory of this recovery. So I think that's going to be a little bit of time before that takes hold. However, given all of these other private funds that exist in these debt funds, and there are a lot of them, like I said, I mean, everybody and their grandmother raised $1 billion in the past year to do either hotel debt or hotel distressed investing. So there's ample capital out there, I think, to fill the gap, but it is a little bit pricier than what is been historically available. And I think for lower levered, really high quality assets, you may be able to get a 5-year loan at, call it LIBOR plus, I'll call it 300 to 500, and that's at 50%, maybe up to 60%, but probably 50% of current values. So you are taking a 20% hit to 2019 type values on that. So it's definitely a lower leverage level. And again, a lot of these funds right now, because there isn't yet confidence in the shape of the trajectory of this recovery, they are typically requiring some aspect of interest reserves being put in. If there's any sort of PIP or CapEx reserves that need to be put in place, they'll do that too. So it's pretty conservative, but again, I think you can get some deals done. And as we've gone out on a few assets to get pricing, we have gotten quite a few bids. Again, I think 3 or 4 months ago, those bids were as high as L plus 1,000. And every day they are coming down a few bips here and there to where now you're probably in the, a little more of a distressed asset or troubled asset may be in the higher single digits. So it's coming there. I just think it's a question of time, and it's going to be something that once people have confidence that they see the industry starting to rebound more in earnest, I think you're going to see a flood of capital come back, because again, as you've seen what's going on in treasuries and in other industries, interest rates are nothing and they're going nowhere for a while. I mean, you even saw the Bank of England gave a warning to their banks to get ready for negative rates. So you're going to see the hunt for yield be ongoing, and that's why I've got a lot of confidence that given the certainty, I think, of recovery in the hotels over the next several years and the hunt for yield, there'll be ample debt capital available in hotels in the years to come.
Well, Rob, thank you very much for all that information. Please stay with us. We'll have you back. And at this particular point, I'd like to bring in Daniel del Olmo with Sage Hospitality. Daniel, thank you so much for being with us. We really appreciate your participation.
My pleasure, and good morning and good evening, gentlemen.
Daniel, talk a little bit about the 2020 initiatives that you put in place in curtailing costs. You've heard from a lens of an owner. You heard from what Robert was talking about on overall industry stats. So tell us a bit about sort of the boots on the ground view of what you had to do for 2020.
Yeah, I thought we had it bad, and I personally had it bad until I just listened to Rob share his story. And obviously, last year was definitely the most difficult, most difficult situation that we've all encountered. As Rob mentioned, we went into immediate action really early on in March, when we realized that this pandemic was going to affect our industry severely, and as a result, our portfolio, our nationwide portfolio of 53 hotels. And we immediately furloughed 91% of our team at the property level, representing about 5,700 people. That unfortunately, of those, we had to then lay off about 4,000 of them throughout the year to really offset some of the issues that we encountered. The second part was really reorganizing our home office team to really be more nimble and agile, delayering our structure to ensure that we could be as proactive in dealing with all of the issues, supporting our field team and our property level team as best as possible, reprioritizing priorities, minimizing any sort of distractions, and also overemphasizing communication, which we felt that it was absolutely critical to enhance our communication with all of our partners, with all of our associates, with all of our furloughed associates, to the point that our co-founder was basically sending out an update that also served an inspiration on a daily basis every single day for the first 90 days of this pandemic, which was really something that we felt was necessary. We then collaborated with all of our brand partners, all of the various franchise companies. We basically, my team and I sit on several councils and started working with them on adjusting brand standards, really thinking about how we would address the situation from a segment and product perspective, really addressing, frankly, the cash crunch that all of us had to face. We also negotiated with our vendor partners that, again, we treated as partners and had a real, genuine, open and transparent conversation to say that at the end of the day, there will be no business unless we work together on, frankly, a resolution, and whether that was deferred payments or whether that was really adjusting the rates or really rethinking, renegotiating terms. And frankly, those partners that ultimately are strategic and think and act strategically, not only accepted that discussion, but frankly appreciate it and lean forward and jointly work with us on really figuring out how to approach this. From a property perspective, we basically retained our utility players and stretched the talent of our teams, our EC teams. We have now a series of incredibly talented management team members across our properties that can handle multiple functions, and during the height of the pandemic, we're able to quickly assume, whether you were a general manager or you were the head of finance or head of HR, you were assuming additional roles that you likely wouldn't have assumed pre-pandemic, at least on a daily basis, whether that is running the front desk or parking cars or stripping beds. The level of engagement and enthusiasm that our team members had without asking any questions and leaning forward was truly remarkable. And we all talk about heroes, in terms of those that took care of all of the people that were affected by COVID. I also think that our frontline team members across the industry really are heroes, and certainly our team members here at Sage are my heroes. We complexed, obviously, as we started looking at not just within micro markets and micro markets, but we looked at it even regionally and looked at how we deployed our talent across, whether that was creating area GM positions, whether that was complexing directors of finance or directors of sales and marketing or HR directors. I mean, across every single function, we saw opportunities to provide leaders that we saw had potential to grow, basically provide them with stretch assignments and frankly, It's given us not only efficiencies today, but efficiencies that we see moving forward. We also then determined that because of the fact that our talent in the field was leaning forward and were willing and able and eager to help the entire organization move forward, we established several task forces. One was what we called Sage Forward, focused on really the creation and implementation of health and safety standards, where we looked at every single standard that was being implemented across the franchise companies, across AHLLA, across many different organizations, and we sort of assembled all of that in a one repository that we would effectively update on an ongoing daily basis, so that all of our properties were getting the latest and greatest of operating standards that were just in time useful at that point in the pandemic. And beyond that, we then also created several revenue generation task forces, all led by various leaders across different functions at the property level that we assembled. We gave a remit of finding opportunities, and those revenue generation task forces basically came up with incredible offers, promotions that were timely, relevant, meaningful for the audiences that were going after, including things such as tactical efforts like a prospecting week, for instance, that we just completed last week, where we effectively were able to get an additional $4 million of business for the portfolio just by effectively engaging people at the field. So again, as you look at all of these different initiatives of it, just a lot of things happening at the same time.
Well, Daniel, thank you for that. That's a great comprehensive overview. Just a quick question on aggregate basis for your portfolio. I'm sure some hotels performed better than the other with all these initiatives put into place. CBRE report had said that year over year on per available room basis, EBITDA dropped nearly 117%. Do you think with these initiatives on aggregate basis, were you able to do slightly better, worse? How did that look like for your portfolio?
Yeah, so when I was listening to Robert, it was really interesting because when I look at our portfolio, our revenue was down year over year about 70% revenue-wise, which basically was obviously driven by primarily by declines in occupancy, and that translated in effectively decline 78% of the GOP line. And so, you know, the truth is that when I think of our portfolio, Abid, there's sort of three buckets in how our portfolio performed. I would say you have the terrible bucket, which were markets that really did not do well at all. Markets like Portland and Minneapolis. Obviously, the riots didn't help. The civil unrest was really unkind to several of our markets. Chicago was obviously another market that was mentioned before. So a lot of the cities obviously were very, very focused on urban lifestyle, luxury, upper upscale and upscale product. So we certainly felt that pretty significantly up there. And again, I think those efficiencies, those cost efficiencies that we implemented definitely alleviated the pain, but there's a point where when literally there is no demand whatsoever in a market like Portland because of civil unrest, or Chicago, we make the very, very hard determination to suspend operations in several of our properties in those markets. The second bucket of markets then I would call that did less bad were sort of the secondary markets and even some of the urban centers, if you will, in some of the cities that we operate in, whether that's markets like New Orleans or Boulder or even Cherry Creek here in Denver that we saw were performing better simply because the leisure business that we were attracting were looking for sort of safe havens for them to really escape their existing reality. And then the third bucket that we have in our portfolio were markets that actually performed relatively well, which obviously relatively is a very important component here, because still the markets were down. But when I look at Oceanside, market in Southern California did well for us, not just because of the leisure side of the demand, but also government business there. Savannah, where we have a great luxury collection hotel called Perry Lane, did relatively well because of the drive-to component of that business. And Austin, we have a DoubleTree in Austin, did remarkably well, particularly because the government and the Department of Emergency Management really leveraged our property there to serve as a base. So what I would say, and beyond that, and I think Robert alluded to it before, when you look at how properties and different type of assets behaved, but I would tell you that extended stay definitely performed better for all of the reasons that we know, project business, et cetera, leisure travelers looking for kitchens, et cetera, while they're out and about. But we also saw the independent properties and the lifestyle properties, for instance, here in Denver, the Maven, the Oxford, and even, for instance, our property in Wayzata, which is a upscale neighborhood outside of Minneapolis called The Landing, they performed actually quite well. So, but again, a lot of that was obviously driven by the nature of the demand that we all had to find, given the absence of obviously group and corporate demand.
Fair enough. And you bring up a very good point. Some of the markets, not only that we dealt with COVID, there was social unrest. And I remember talking to an industry colleague in California when California was burning. And whilst we're dealing with all these challenges, quite candidly, it felt like the only thing missing was locusts, and it would have been biblical proportions that
Exactly.
we would have had to deal with. But thankfully, that did not come to fruition. And hopefully we will get through this before too long. One question, and I will turn it over to Sam. Talk a little bit about the trends coming out of it. What business segments do you think are starting to show green shoots for recovery? And how fast do you think that will come back?
Yeah, look, I think we took a very conservative and cautious approach to our budgeting. The reality is that we do not believe that there's going to be a return to the 19 business levels until late 23 for most of our markets, and in some cases 24. What we are certainly hoping for is on the restaurant side. As you know, we also have a restaurant company called Sage Restaurant Concepts. We actually believe that the restaurant business, particularly the independent restaurant business, is likely going to come back sooner, as basically consumers are going to adopt a bit of a roaring 20s lifestyle that will likely start sometime later this year, moving into the summer as we get hopefully closer to a more widespread vaccine distribution and implementation. So that helps us, particularly in those assets that are more experiential and lifestyle in nature. So definitely the leisure demand will continue to help us throughout the year. We're also seeing small events, small groups, social events, certainly a lot of micro weddings that we hadn't really seen in our business before, starting to, or actually continuing to grow and help us to continue to drive occupancy across our portfolio. And then as we move into later in the year, into 22 and beyond, that's when I think some of the certain components of business travel will return. Ultimately, there's nothing like having the ability to do business in person. I actually spoke at a conference that we hosted last week at our JW in Cherry Creek. And we had about 25, 30 people in the room and about a couple hundred people that were attending virtually. And there is just nothing like the excitement and the enthusiasm, and frankly, the energy that you get by all being together in one location. And that then will also drive and ultimately stimulate the groups and the convention business. We certainly believe that the larger conventions are going to be attended heavily in a mix of both in-person and hybrid virtual attendance. And we think that's here to stay. And frankly, those conventions are going to become larger in terms of the audience that they'll be able to address by effectively being able to serve both those that believe that there's a not only a need, but also a benefit, frankly, of attending in person, again, because of the relationship aspect of doing business. But those conventions will ultimately be able to attract and convert those virtual attendees into in-person attendees. And so again, we are long-term. We've been in business since 1984. We've seen a couple of downturns, nothing obviously like we've been talking about on this panel like last year. But we believe that the next 24 to 36 months will provide us some runway to get back to where we are. And then frankly, when we get back to where we were, I think the way that we do business tomorrow will look very different from the way we do it today.
Well, thank you, Daniel. Let me turn it over to Sam, and I'll be back in a moment. Sam.
Thank you, Abid. Very interesting. I took some notes about, you talked about Sage Forward, Sage Clean Focus, and more like experience focus. Could you give a little bit deeper into what it means, and particularly you are talking about enriching the lives on an experience of people who work for you, and also your customers. Can you just tell us about some specific examples and how it actually works? Because I like the concept is fascinating.
Sure, Sam-Erik. Basically, what we saw in March was that there was a need to organize ourselves quickly, swiftly in implementing standards to make sure that our associates and our guests felt safe. That was of paramount importance for us all. And we felt that the best way to do that was to assemble a task force that would help us really aggregate all of the learnings. And the original name of Sage Forward was we're acting in the now normal, because the reality is, as you both may remember, gentlemen, every day was a new story, and every market was a new story, and we were effectively dealing with 53 different situations where one size does not fit all. One size equals one and fit one. And so this task force was incredibly nimble and allowed us to effectively adjust literally on the fly those changes that we had to make. Then the second piece that we thought was important to address was, how do we evolve the experience for our guests? And so from a technology standpoint, mobile key and the implementation of basically a frictionless experience for really addressing guest needs, anticipating the fact that some guests would not feel comfortable in going to hotels unless you would give them an opportunity to really have almost a touchless experience all the way into their room and out. So the second pillar, which really was about sort of the experiential arm, to us serves as a innovation platform where we are looking at rethinking how we go to market. And so an example of this is the front desk. The way that we have, as an industry, approached the front desk has virtually almost not changed, with the exception of a couple of really sort of operational and design elements in terms of creating pods, and to some degree allowing people over the last couple of years to check in via your mobile. But even that really was not as prevalent. The reality is there's an opportunity now to take that front desk experience and think about it more in terms of an ambassador. How can we make that much and particularly because we obviously play across all of our segments. We play in the lifestyle space. So how do we really create that functional interaction? How do we evolve that into an ambassador interaction where those guests that are coming into the hotel and are wanting and desiring that interaction with our team members, that it becomes much more of a dialogue of how we can really amplify their experience versus just checking them in. And so that then allows us to really adjust the cost structure, look at different ways of how to go about it versus just the typical way of addressing it. So that was just an example, but it provides us with literally an ongoing innovation platform that we will be able to use to constantly innovate and evolve our offerings across both our branded portfolio, branded product, as well as our independent product.
Good, thank you. Are there some services or amenities that might not survive the pandemic and after you've gone through this exercise, or may not be needed because the expectations of your customers have changed?
Yeah, I think one thing that comes to mind is stay over housekeeping. I think definitely the green element of housekeeping. And I think that is definitely something that both from a guest perspective and an operator perspective, I definitely believe that that's going to evolve, and I think that will help. That will be a learned efficiency, frankly, that I think will continue. I think F&B and the way that we manage F&B across the different segments and chain scales will evolve. We're fortunate to be part of the Marriott Advisory Council, and we have very, very healthy debates with our other owner-operator partners to really rethink what it means to have an F&B experience, what that means to our guests, and how we really address that in a different way versus the standard way from an operating hour perspective, from just an offering perspective, so that ultimately we can exceed expectations rather than just meeting it based on what our guests were expecting in a luxury hotel or lifestyle hotel pre-COVID. Yeah. So those, I think, are just examples, but there will be many more opportunities of really adjusting how we go to market tomorrow.
Yeah, I know you mentioned the keyless and the touchscreen experience that are standards that people are expecting. So I think that is something. I just want to, before I give it over to Abid, in one of our earlier conversation, one of the hoteliers or hotel owners mentioned something called prescribed hospitality. There is now a customer base that want to order everything in advance, and they basically don't want to meet anyone from the moment they arrive until they leave. But everything has been personalized up to their expectations before they arrive. Is that something that you are experiencing, or maybe that's something else that a smaller hotel operator have mentioned to me?
Look, I think, Sam-Erik, I think that we're in the hospitality business to deliver experiences, enriching lives, one experience at a time. And I think what that means is that first and foremost, not only do you have to listen to your various target segments and really understand their needs, but also anticipate that. And so I think the way that we execute against that across the portfolio at different levels, in our luxury collection properties and at our Ritz-Carlton in Chicago and our independent properties, I believe that personal human interaction, I think, will actually be even more important going forward. And if that means that your guest that is coming in wants an absolute touchless experience and wants to feel really completely independent, then it is our task and our duty to really make that happen. But often what we notice is that there's now a desire to make those interactions much more personal and, as you say, much more intimate. And I think that will set the lifestyle and experience players that are generally focused on amplifying those experiences aside from what we call pretend lifestyle, or the functional operators that at the end of the day If it's just a bed, then there's many options for that, and that's not the category that we want to play in.
Right. Okay. Well, thank you very much. Great answers. And Abid, you have a few questions before we bring everyone together?
Well, you know what? We are running over. So, Sam-Erik, if you don't mind, let's bring everybody together. And I will continue with Daniel for at least the next question. But this question is for all three of you, gentlemen. If we are writing the playbook for lessons learned, and what would we do in preparation should we ever have to deal with a similar situation? What would your 2 chapters contribute to that playbook? And Daniel, if you wouldn't mind taking the lead on this thing, you writing 2 chapters of this playbook, what would you think is must-have from lessons learned?
Abid, this question gives me a big headache, and I hope that we don't have to ever write this book again. But what I would say is, chapter number 1 is act immediately. And I think Rob mentioned it before, panic fast, I think is what Rob said. I love that. We certainly acted immediately, and it was critical. Chapter number 2 is have compassion and really overemphasize humanity. At the end of the day, we're in the hospitality business. We deal with people, whether it's our associates or guests or constituents in the community. Our relationships have grown stronger over the course of the pandemic with all of our constituents simply because we showed that we cared. Those would be my 2 chapters.
Well, thank you, Daniel. It's funny you bring this up after having gone through all the ups and downs of the industry, and the cycles continue to get shorter and shorter. I think the industry is going to need sedatives pretty soon because we are so panicky every time. So, Rob, over to you. What would your 2 chapters include in this book?
I like Daniel's. His was good, right? It's if you're going to panic early. But I think I think the 3rd chapter would be relationships matter. I think when you're trying to make your way through this, you're not an island. You're not doing it on your own, and it's not just even within your own company. It's the relationships you have with your managers, with your brands, with your lenders. I think it makes us, having gone through the trenches with people, it makes us rethink how do we want to do this in the future, because we now seen that the only reason we got through so many of our issues was because of the relationships we had fostered with these other parties, and those are more important than I think we believed at the time. So I think chapter 3, relationships matter. I think chapter 4 is know that you can rethink everything. I think looking back, again, I've said this a couple times, I think a silver lining to all of this, going through this, is that it's going to allow us, and not just us here internally at Ashford, but at Sage and a million other places, to make changes that we never would have had the institutional will to make if we hadn't gone through this. Things that we probably should have done, things that probably we ought to have done, but it might have ruffled too many feathers, and so we wouldn't have done it. But in this case, when you have a clean slate, you can make those decisions. And so I think the way that we're going to be operating hotels and overseeing hotels in the future is going to be completely rethought. And that cost savings and opportunities that we didn't think we could have done, we can. And I think that's a lesson to always know that you can push yourself farther than what you think.
Well, thank you for that. And Robert, your 2 chapters.
Well, actually, only think of one at the moment, but being the hotel data nerd of the group, be flexible in terms of how you read your management reports. All the old thumb rules and conventional theories of economics and supply and demand just went away this year. And we really had to dig into the numbers, and we found some interesting statistics and ways to look at your operations. And I think when we look back at 2020, we're going to learn a lot and how things advance and such. So be open-minded when looking at data and how you analyze it and use it.
Well, Robert, a question back to you. Our chart of accounts within the industry is relatively unchanged over a period of time. We might have taken out the telephone department as a single line item and dumped it somewhere else, but we fundamentally have not changed how the business performance is measured. Is it still applicable in the environment that we operate in today, or should it be changed?
Well, I have the pleasure of serving on the HFTP Financial Management Committee, which is responsible for maintaining and editing. We were in the process of updating the 11th edition in an attempt to put out a 12th edition. And like a lot of things, COVID interrupted that. So I think maybe one of the benefits is that our conversation, what we're thinking about, has evolved just simply in the past 12 months. And so the way we look at revenues and expenses, again, wanting the USALI to be a management tool, you may see some shifts that we weren't thinking about in January of 2020, but we're now thinking about in February of 2021. So yes, I think there's a committee representative of owners and operators and the brands and lenders and outside parties. It's a diverse group, and I think what we learned the past couple of months will definitely have no influence on the 12th edition.
Thank you. Rob, a question for you. From owner's lens, obviously cash preservation was the single biggest topic in front of us on our radar screens. A lot of the repair and maintenance type of things obviously were deferred. How do you see that coming out of it once we get through this pandemic? And Daniel, for you, it'll be sales and marketing showed a huge savings. So apart from the staff that was furloughed and then possibly laid off, that seems almost counterintuitive coming out of this pandemic. So Rob, if you wouldn't mind asking the question on repair and maintenance, and Daniel, after that, if you wouldn't mind addressing the sales and marketing.
Yeah, there's no doubt that everybody stopped everything that was not absolutely required, whether it's from life safety or something else. We had a roof that was being peeled off on one of our hotels from hurricanes. Those sorts of things you kind of have to do. But you're right; those things have been deferred, and catch up is going to have to happen. And I think this is where we've seen great help from our brand partners. Is that you're seeing CapEx work, whether it was PIPs or other required CapEx or brand standards that were needed to be done in 2020 or 2021 are now being pushed out, a year or two to give all of us a little bit more runway to get those projects done. So I do think you're going to see a shift of CapEx out from here, where people are going to be rethinking CapEx. And frankly, I think we're going to be rethinking all of our CapEx, of looking at our CapEx plans and the lessons that we've learned over the past 12 months here to be thinking about, okay, we do need to do an F&B renovation here. What do we want to do? What does the new reality of F&B, as Daniel was talking about, which I think is absolutely correct, what does that look like now? And so I think this puts a lot of things on the table. So here over the next 12 months, I think we'll be catching up on more maintenance type things, but doing a deeper dive and rethinking what CapEx looks like over the next several years. And fortunately, the brands are working with us on that process.
Thank you. Daniel, sales and marketing thoughts?
Yeah, first of all, Rob, I completely agree with Rob on all of the comments that he just made. We're taking exactly the same route there. As it relates to sales and marketing, listen, I mean, we've coined for 21 as part of our plan, we've coined the term that we need to own the upswing. And the reality is that, even though obviously our property teams got really decimated, we were very, very thoughtful to maintain our sales leaders, and we were very thoughtful of maintaining the sales teams. And what's interesting about that, Abid, is that, again, whereas perhaps in the past, we might have been a little bit more generous in terms of having segment-specific sales people, the reality is now what we've seen is that the productivity that you can get out of utility players that are A+ players from a sales and marketing standpoint can actually drive you as much, if not more, of the returns that we were expecting out of that sort of investment of talent. I would say that's one. Two, I think for us, we are definitely not just embracing, but proactively engaging our brand partners or franchise companies, because that's where I think now having a strong brand really matters, and they certainly understand that their value proposition is related to driving top line. And for us as operators, we need to make sure that we take advantage of every single tool in the toolbox that they have, and frankly help them reinvent and evolve the toolbox that they had in the past, including rethinking, negotiations with OTA partners, get more visibility online, really rethink about, how to market your properties versus the past. On the independent property side, Abid, I would tell you that we are and have been investing for the last couple of years in creating a platform that allows us really to have very specific CRM activities. We're about to launch a affinity platform for our independents here that we're about to test in Denver and rolling out later this year, the rest of the portfolio, which is very exciting. So ultimately, we're looking at I would say, a more efficient way to go to market, but a big emphasis on how do we think differently about owning the upswing.
So one more question, and Sam-Erik, I promise you these are the last two questions, and then I'll turn it over to you because we are way over our time. Whilst we have appreciated the standard deferral in the operations, the brands have been good partners in making sure that we can make a go of it. Some of those brands might come back. Some of those brands standards we might or might not want. In absence of these standards, what really makes a difference? And Daniel, for you, from operator perspective, what's the difference then between upper upscale and select service other than $30? If we don't put some of these standards back, what can the consumer expect?
Yeah, listen, it's a great question, Abid, and it's interesting. It's almost as if you were listening in owner advisory council conversations that we've had with our various brand partners over the course of the last couple of weeks, because you are right. Ultimately, at the end of the day, as a guest, if I'm going to stay in a luxury or upper upscale property, what is the value proposition that I receive? We at Sage have been taking I would say, a very strong stance of thinking about the experience that you get at the property when you are in a full service luxury lifestyle environment, to make sure that the deliverable there is always exceeds the expectation. And you can do that, again, with a higher level of service, certainly making sure that whatever ancillary services and offerings that you provide are meaningful, are differentiated, are unique, and are relevant. And again, as I look at our market share, we actually increased our market share about 100 bips to 109.5 over the last year, because we did not, while we reduced expenses and frankly only funded the essentials like Rob mentioned before, we did not reduce the experience. And in fact, we pushed our GMs to think even more creatively about amplifying the experience in little ways. At the end of the day, what matters is the detail, more so than having 3 restaurants open. What do you do with your F&B proposition? What do you do with your minibar proposition if you have it, versus just having it for the sake of a standard?
Fair enough. And Rob, your asset management team, the top 3 items on their hit list while they review the performance of hotels for 2021?
Again, I think it's probably focused on again on the cost controls and maintaining. I like I like your phrase, Daniel, kind of own the upswing. I like that phrase. And I think it's similar, is that as this revenue is coming on, there's going to be the temptation to layer on these costs. And so I think it's holding on to those as much as we can. I think number two is rethinking the mix of the hotel, given that you're seeing conventions gone for at least some period of time. We're now really starting to think about the mix of guests that we have. And I'll give you an example. We have the 700 room Renaissance that's in downtown Nashville. It's a great asset, newly renovated. It was absolutely screaming prior to all this. And this makes it difficult because, needless to say, it relies on a lot of group business. But fortunately, Nashville is a very strong leisure market. And so you've got a 700 room hotel that's completely rethinking the way that they are approaching guests. And so I think that's the sort of creativity that we all have to grasp onto in this environment. And I think the last one is, again, what mentioned earlier is on the CapEx side, is what is the right way to be deploying CapEx, because we are asset by asset looking at all of the cash that we're putting into these assets, whether it's still funding operating shortfalls, looking at debt and interest expense that are coming due, and CapEx that are coming due. And depending upon whether or not those IRRs make any sense, or those returns make any sense, you've got to maybe rethink the asset. And so I think I think we're hopefully going to see that as an opportunity to do some interesting things. And so again, we're trying to use the time to stretch ourselves a little bit in how we're thinking about doing business as usual.
So before I turn it over to Sam-Erik for the last time, Rob Mandelbaum with CBRE Hotel Research, Rob Hayes with Ashford Hospitality Trust, and Daniel del Olmo with Sage Hospitality. Gentlemen, great conversation. My thanks for you making time to join and share some of the best practices. Over to you, Sam.
Thank you, Abid. Well, I'd like to first of all thank all the panel. I mean, I had other topics I want to talk about because we got into a very good conversation here, and I truly hope that you will accept an invitation to join us another time, and we can expand on certain topics and dig deeper to another topic. So great conversation. Thank you so much. But I also like to thank all the live viewers. We had plenty of viewers, and there was Alex Polling had a great question, so thank you very much for that, for joining in. And also, I'd like to thank all the replay viewers and that you have joined, and there will be a video here coming up, and we are enticing you to take a look at that because of some other great conversations we have had with other guests. So I look forward to welcome you all again to our next episode, which will be very, very soon. So thank you again, everyone, and we'll see you very, very soon.
Thank you.
Great, thanks.
Have
Take
a great
care.
day.